The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stock Take. My name's Nick Cummings, and with me today I have Angus Donohoo. Morning, Gus.
Good morning.
And also joining us all the way from Canada, Graham Witcomb. Afternoon, Graham.
Hey.
Well, boys, as one member put it in the comments last week, the kids are back again. We've returned.
Burning down the house.
That's it. So let's start off by talking about something that's a whole lot less sexy than AI or the impact of weight loss drugs, and that is the death care or funeral industry.
Do people call it death care?
Yes, yeah. I think that's actually what its sort of business sector is listed as. Yes,
well, they need to rebrand.
I know. Investors talk about battleground stocks with when a stock's got very very different and divided opinions about it, and I think this applies here to this industry. We covered InvestSMART for about a decade, I think, at II, and over that time it 10-bagged, and then it really severely underperformed as competition came into the sector. And it's the same in the US with a company called Service Corporation. That is their largest funeral operator over there. It's had periods of good performance and periods of underperformance, and it's also the same in the UK. With a company called Dignity. They eventually collapsed, but before that, their share price performed quite well. And so it doesn't really matter what market you look at. Contrasting performance, seems to sort of plague this industry. And I guess it's in my view, understandable. So this is a lucrative model on one hand. You have steady volumes. In some cases, they're rising with the aging population, and extremely strong pricing power. But then on the other hand, you have a ton of competition and balance sheets that just seem to be stacked with debt. Gus, I might bring you in now. You've recently written about the second largest funeral operator in Australia. I think the only listed funeral operator on the ASX, Propel Funeral Partners. And I don't think you went quite as far as to say this was an avoid, but you certainly didn't like what you uncovered. So can you tell us a little bit about what you found?
Yeah, you're absolutely right. So it's the main funeral care provider on the ASX. It's the second largest. So they're sort of doing somewhere in the order of probably about 10% of the funerals in Australia, whereas InvestSMART, who you mentioned, who has been taken private, they're doing about 20%. So you've got 200, they've got 200 locations, just about 2/3 of which they own, 38 of these cremation facilities, then about 9 cemeteries. They've even got some pet cemeteries. But really this business has sort of been a roll-up. They've made about 20 acquisitions just in the last 5 years, and they just sort of have been going through and buying up more and more funeral homes. And I suppose what I didn't really like about this business, there were a few things that kind of made me cautious, but just the amount of dilution and debt that they've been taking on to kind of roll up these businesses. And there's such a kind of in that sort of a business model, there's so much of a expectation that you can just keep rolling up into, up forever. And what happened with InvestSMART when that business started to run into trouble was government intervention started to come in. They sort of essentially got blocked from acquiring a cemetery that they were trying to buy. So I just think, you've had something like 40% dilution just since 2021 in this stock. And so when I see something like that, there were a few things. The thing that got me interested in this business in the first place was, my grandfather died, which it is sad to a degree, but, he was 98. So, it was actually a blessing at the time. But we went through that whole process of a funeral. And if you've, I think probably most people at some point in their life have had some direct or indirect experience with funerals, and they are astonishingly expensive. And I also just sort of observed that, I've been to a few over the years, and it just seemed like the quality was less, the price was astronomical.
Yep.
And there was this incredibly kind of galling thing in our experience where, we'd paid, I forget, over $10,000 for this funeral. And at the end, the undertaker, this nice lady, but she made this great big show about coming over and giving us a candle and saying, here's this sort of gift bag. Inside there's a candle that is our gift to you. And I just was like, what is this? But I really sort of expected that this would be a good business for many of the reasons that you outlined. You've got an incredible amount of pricing power. The way that I suppose the problem is, though, you're dealing with death. It's very, very, very sensitive. That also means that to some extent your competition is asymmetric because you are going to be competing against churches and organizations that don't pay tax and that, at least in theory, don't have a pure profit motive. But I think more fundamentally, it was just the extent to which the business can keep rolling up that made me a little bit unsettled.
Yeah, absolutely. I think you bring up a really interesting point about the pricing power. I started to think about why this is the case, and I kept coming back to the customer themselves. And I don't know if you guys agree, but essentially it's hard to think of a less informed or a more badly informed customer than someone purchasing a funeral package. Even if you think about a wedding, which is an infrequent purchase, you talk to your friends and family, you have years to prepare for it, you walk through the venue. None of this happens in funerals. Customers are quite time poor. There's no chance to do thorough research. So you just sort of jump at whatever's easiest. And then it's not really discussed either. Like no one calls up a friend and says, "Oh, hey mate, my Nana's just passed away. What did you do for your dad's funeral? How much did it cost? Did you get a few quotes?" Like, it's just not discussed either. So I think it's there's a real vulnerable customer here, badly informed.
I mean, I think you're exactly right. And I mean, an extraordinary case in point in this is that the standard markup on a coffin is 633%. And so,
that's astonishing.
It's almost, the thing that I kept coming back to here is it's almost like the luxury industry. You're forcing the common consumer, the common person, to sort of be making a luxury purchase at the time, to your point, where they're at the absolute maximum in emotional stress and emotional trauma, and probably at the least likely place where they're going to, bargain and kind of really sort of look for a better price. So it is a very powerful industry, but that power is what brings in regulation, I think.
And I think it's also interesting that you're spending someone else's money in a way, which is always just way easier to overspend, because you've got in the back of your mind, right, there's this inheritance coming, or it's coming out of the estate. And
that can be prepaid as well.
Exactly. And if you liked the person, you're thinking, oh, well, I want to do what they would want. And I think they would want the nice coffin or whatever. You don't want to do something that they would disapprove of. So you're kind of trying to impress someone who's not there, using their money, and that ends up leading to overspending, I think.
And I think absolutely. Kind of to the business case of this too, I'm always sort of I try and keep an eye out for mission creep when you see that kind of the story that is told in the prospectus just changes a little bit. And one of the things that I was sort of finding when often it was actually third parties talking about the business was this idea that there was going to be all this growth in the prepaid funerals and funeral insurance. And what ended up happening though was there were a lot of sort of sharks in that industry. A lot of regulation kind of came in to kind of really sort of try and regulate and sort of control the kind of out of control growth of people doing that. And you can sort of even see it on their balance sheet, because these sort of contract liabilities and contract assets have only actually doubled, whereas sales have gone up 15 times, just in the sort of reporting periods. So it's I just kept coming back to just how much sort of risk this has from regulation. And there was a very, very frightening Four Corners episode that was aired a couple of years ago, about 2022, and it caused a lot of disruption in the industry. But a lot of the problems that they raised hadn't been resolved. And one of the things that was, apparent with these large kind of roll-ups. They try to conserve costs by consolidating the services. So lots of different funeral providers. So you have these undertakers, you've got white lady that are these women in the white outfits. You've got the kind of more traditional men with coattails. Multiple funeral providers, and I don't know if it's those specific ones, but multiple funeral providers might be coming in and using the exact same mortuary facilities, storing the bodies in the same place. So there's something just a little bit unsettling where people think they're paying for a service, but that's not quite what they're getting.
A luxury service.
Exactly. So it's a luxury facade with a very McDonald's style, back of house. And I don't think that's what people think they're getting when they're paying, the cheapest funeral in Australia, in Sydney anyway, I think was $4,000. There's a website where you can compare costs, but, the range was sort of $4,000 to $15,000. And that's a huge cost.
Yeah, it's massive. Absolutely massive. I think the thing that turns me completely off is just the roll-up factor. I've just seen this a few times in the ASX, and it just rarely works. It works for a little bit.
Can you think of any that have worked? I really struggle to think of any that haven't blown up at some point.
Yeah, it doesn't actually even, it's not just on ASX, it's worldwide. There's very few, exceptions to the rule. And the reason why is essentially, a roll-up is just taking advantage of a private public multiple arbitrage where you're buying a business at, say, 4 times EBITDA and you trade at 6 times or 8 times EBITDA, and you just keep doing this. But it also treats these small and business owners for fools, that they don't know what their business is worth. But they eventually find out, these executives that think they know everything about the industry, that these small and family business operators do know what their business is worth. And eventually they raise too much debt. These, larger ASX listed businesses, they buy an acquisition that doesn't quite fit, that's too large, and it all just comes crumbling down. And then your only really competitive advantage here, and I think you're starting to see this a little bit, Angus, with Propel or just funerals in general, is capital. So because these ASX listed companies can go and raise money, go and raise debt, that they've got the capital so they can roll up the industry. But now you've got private equity coming into the space, and they've got a ton of capital, and they're starting to push multiples up that people are paying for these funeral homes. And I just don't know if you want to be in a space where you're competing with, where your only competitive advantage is capital. It's just got to end it badly, I think.
And you're competing against, religious groups that can be quite cautious, and with, frankly, property prices in Australia. And that's another thing where there was a little bit of mission creep. Initially, Propel, they promoted themselves around the time of prospectus that they weren't kind of going into that sort of land banking world. But when you look at their balance sheet, it's gone from 50 million in land to 250 million in land assets. So they have actually been sort of buying. So there's just been those little things, and it's interesting actually. The executive of the business, none of them really sort of started in the funeral industry. They all were. They're sort of M&A people and actuaries, and they were quite involved in InvoCare. Bought for about 190 million, bought one of the largest New Zealand funeral care groups. And it looks like basically what's happened is they've seen the makings of the industry. They've sort of been involved in that big deal, and then they all thought, well, this is a real opportunity here, and sort of basically tried to replicate that on a bigger scale. But it's interesting when you look at a business that none of the executives, none of them cut their teeth as undertakers. And so, so if there's a risk in this industry where people are really concerned about the quality of the service that they've been getting, and actually the ACCC did fine InvoCare back in 2021 for essentially some of the funeral care homes that they had purchased were still marketing themselves as family owned, even though they were actually owned by InvoCare. And so,
this happened to Propel as well?
It happened to Propel. This was what Propel was fined for in 2021. There's just that. I mean, they've now been in this business for 15 years, a lot of these guys. So I'm sure they know it very well now. But it is just sort of interesting where it's not an organic kind of. I can't think of that many corollaries where I've seen someone sort of start from completely external to the industry and kind of come in and become the second largest player in it.
Yeah, it's kind of just leaves a bit of a sour taste, doesn't it? I don't really know.
Yeah, it's a small. Problems. I mean, it's a small factor. Arnaud from LVMH, he started as an M&A guy as well, so so it can work out very well. But it's just there's sort of lots of little data points on this. But I mean, at the end of the day, really, it comes down to the fact that it's trading on 40 times earnings. It's often had its leverage. Its leverage got up to nearly 5 times, and they just had to do a big capital raise at the start of the year and dilute shareholders more and more. I think it's one to watch for sure, because I think this should be a good business. People are dying. I think that's a true statement.
Yeah, that is a true statement. No, there's certainly it's certainly a lucrative model. That it's got qualities that you would appreciate in any business. I mean, I think there's 200,000 funerals in Australia. There's an opportunity to take market share. There's an aging population, as we've talked about. There's plenty of pricing power.
Is an aging population good for it though? Doesn't that just delay the funeral?
Well, yes, I guess in theory,
a growing population would be good, I guess.
A growing population is good as well, but I think as more Australians, I think, Angus, you said 1 million Australians by 2040 will be over 85. I'm assuming.
So
we're
kind of like on the cusp of
the
wave.
Unfortunately, people start dying. Whether that, how much that impacts volumes, it's hard to say, but there could be a slight tailwind, but volumes are at least steady. And then you've got pricing power on top. So there is some qualities there that you would like. We might park that there. It's rather morbid subject.
It is indeed.
And we might come to you, Graham. This is a very, very big change of subject. But anyway,
I don't know. You got to go 6 months earlier in the process.
Yeah. Anyway, you've recently wrote about Pro Medicus. This is a business I think we've missed at II, or we've definitely missed. I mean, it's a $14 billion company now with share prices up 150-fold over the last decade. I mean, there's been some life-changing money made here, and sadly we're not amongst that. But I think we've always recognised it as a high-quality business, but it's always been just too expensive. So most members probably wouldn't be familiar with it. So if you could just run us through what it does first, and then we might go into some of the more detailed stuff.
So Pro Medicus is it makes this imaging software for medical imaging specifically. It's given to radiologists, and they are able to view the different medical exams and make their analysis. It has a bit of an edge compared to the competition in that it processes the images remotely and then streams. The way kind of management describe it is as a Netflix kind of setup where traditional imaging, the radiologist would have to download the whole file, which may not sound like much, but for some of these imaging files, they can be absolutely massive. So it can take quite a while.
Gigabytes and gigabytes, aren't they?
Yeah. So it's quite a struggle to do that. And what Pro Medicus developed, or at least what it bought when in 2009 it purchased this company that was doing this, it kind of turned it into a Netflix kind of setup where instead of trying to download the whole file, it would just stream pixel by pixel. And so instead of kind of getting the whole movie, you're just getting one little slice of it at a time, which was relevant to the radiologist. That then sped up the process and made it a much more convenient and fast process for the radiologist. So it's done really well. Over the past few years, it's built itself up to around a 7% market share based on the number of exams that are being conducted. This is in the US mainly. And it's just an amazing business. It's got to be, among all the healthcare companies, one of the best in terms of it's got like a 50% return on capital. It's tripled revenue over the past 5 years. It's got margin, like a gross margin of more than 99% and operating margin of 67% or so.
That's higher than MasterCard and Visa, which is astonishing.
And what's also crazy is that those margins are triple what its competition is. So it's not just an outlier in among other companies that might be competing in software. It's an outlier like by miles for this industry. And that kind of shows just the value that it provides these radiologists. So there's a really great case there that it's going to continue growing its market share. It's obvious that it's liked by its users. And yeah, the only real catch, and we recognize this, none of this was really lost on us. The problem was that it wasn't lost on anyone. And so the stock has always traded at this ridiculous level. At the moment, it's over 150 times earnings, which is, you've really got to assume that it's going to be, just miles bigger in 10 years' time, and there's no downside, no possibility of it failing to justify the case today.
And there's some pretty big assumptions, right? I mean, this is an industry that, changes. I mean, 10 years ago, you wouldn't have expected an Australian startup to compete with GE and Philips and Siemens and all these massive companies and take market share and have this leading product. The other thing I struggle with, wrapping my head around the valuation is, if this was a business on 150 or 200 times and it was just inflecting to profitability and had 2% margins that, you thought could go to 50%, it's a different story. Whereas this already has stellar margins. So pretty much revenue growth has got to do all the heavy lifting in terms of moving the share price and earnings. And it just has to do it for so long without any interruptions to justify today's price that I always struggle with the valuation. But as you said, this is, I'd say, even outside of healthcare, Graham, this is probably one of the best business models I've ever seen. And that's all over the world. It's incredible. I mean, they've just got so many ways to grow. They sign up new customers. They usually raise prices when these contracts come up for renewal. They operate a transactional model where every additional exam, they get a fee for it. It's pretty good. It's run by a founder owner. The only bad thing is, as an Australian company, we celebrate all this, but we don't get the benefit of this because they're not in Australia. And the reason why is the founder says that bureaucrats run our hospitals, not radiologists. So there's no radiologists in Australia get the benefit of the product yet.
Yeah, I think that's the same reason they're out of Europe. Well, they're in Europe partly, but that it hasn't been as big there is that it's it obviously adds value to the radiologist, but if you're the say the head of finance for a hospital, then you're not kind of on the ground making that decision, and you're then much harder to justify the whatever it is, $100,000 per clinic, $200,000 per clinic that they're demanding.
Yeah. I think it's 50%, 50% more expensive than any of their competitors, which just shows you how good the product is. Gus, is this one that you have any thoughts on, or?
I mean, it's an incredible business. I think I actually worked, believe it or not, for at one period of time on an AI company that was trying to get medical approval for its product. And I think one of the things that's so interesting with this business is how well entrenched its AI product can become because of how difficult it is to get through that process of FDA approval. So they've got, these multiple products already FDA approved. And so I think, even, and they have that quite open architecture, it seems, where they are sort of letting other products come in here. When they're already entrenched in these hospitals, that gives it such a long kind of essential runway inside those businesses, because they tend to be, hospitals that they're deploying really innovative technology, but they're often kind of, there's a lot of logistics to actually go through bringing in a completely new system. I just think it's interesting with the funerals, what we were looking at there is something that's really hampered by regulation. But here I think it creates such an additional halo around this business. But
the AI might be what cracks the European and Australian markets, I think, because at the moment most places don't offer any kind of reimbursement for the actual software, but they do offer reimbursement through Medicare or other things for the different algorithms that are used for the detection. So that could be a way to crack into, I don't know, getting a bit of extra funding for the hospital than for the product, which might ease the burden on those bureaucratic setups.
And I think, Graham, they're taking sort of an Apple approach. Is that right to this? In one respect,
yeah. I think that seems to me to be a really clever strategy for them, because AI isn't their their strength. They do have, I think, one approved product at least. Maybe they've got more, but they've kind of opened their software up to having other algorithms plugged in through APIs, and that means that they then don't have to rely on being the one who produces the top performing diagnostics, and instead they can just stick to their kind of portal excellence and instead leave other third parties to produce the software that does the actual detection and analysis. The idea is that they can then present lots of different models to the radiologist, and rather than the radiologist have to open various different applications to use different AI models, they can access them all through this one visual setting, which does kind of feel like Apple. It's
the App Store.
You kind of got exactly.
The biggest downside risk here that sort of strikes me, or the most kind of obvious one, is just that when you're doing, because they're essentially providing servers and they're sort of doing the cloud-based analytics in a way, your risk of cyber problems is much more significant than, because a giant hospital, if it does lose access to the internet, or if something really disastrous befalls it, I've spent quite a lot of time looking at the CDN companies, which are the content delivery networks, so the ones that do kind of your Netflix streaming or whatever it is, and all of them have had something go wrong where an entire region's network has come down, and every time the stock price has been wiped out, 10 to 20% for these different companies when they've been at fault of this happening. And so the risk when it's providing essential medical care is that extra layer above. Though I'm sure they've got all sorts of redundancies built in, but that is I think it is an unusually highly exposed to cyber threats. I think this business.
I agree.
This AI in healthcare, I don't think is as overhyped as it is in some other industries. Like anecdotally, I just had knee surgery, and when I saw the surgeon, he was reading through the diagnostic report and actually spotted a few errors and changed my surgery slightly. So I think there's room for these AI models and applications to come in and work alongside humans pretty much and start to reduce the human errors in some of these diagnostic reports.
Yeah.
Admittedly, I'm only 3 weeks into the recovery, so it's unclear whether the surgeon or the radiologist made the mistake at this point, but I'll let you know.
Medical imaging seems kind of made for it as well, because it's all about pattern recognition, and
exactly.
that's what AI does best. So I've got no idea. AIs can already outperform radiologists for the detection of a couple of different illnesses. So I think it'll only be a matter of time before it can do it much better than radiologists for most things. And the radiologist is there as kind of the gatekeeper for the AI, or it's a second set of eyes.
Yeah, it's a very mature area relatively, the sort of machine vision space, and this is just such a kind of perfect application for it. And it's been happening for quite a while. But to put some numbers on the board of this, because the thing I was working with was also machine vision. It was something like $20 million was sort of because you had to go through these different stages of approval, and so not only do you have to, any competitor, not only do they have to kind of build the product, but they then have to go through each of these different stages of approval. And this was just for a camera that's looking at patients and then providing medical diagnostics. And what they're often looking for is what they call prior art. So actually getting through the approval process. If you can say, so a company like Pro Medicus, they can be pointing at the patents they've got, and even the ones that aren't AI related, but they can be pointing at those patents and saying, this is just a new thing we're integrating on top of the workflow. And so it's just a lower bar for getting that approval. So it's I think this is a really, the business models for these large language models are still, there's a lot of kinks being worked out, I would say. Whereas for this, it's just such a clear-cut case. And to Graham's point, these things perform magnificently, far superior to human eyes, though, are still prone to the errors. So do need, very sophisticated oversight.
Yeah, that's really interesting. Graham, what has to happen for us to buy it? I think that's the question that's
it just has to go down.
Yeah.
I don't know. I mean, it really, I think the only way we're going to be able to find a price that's even reasonable, I really don't think it's going to get to a reasonable price anytime soon unless something really catastrophic happens, like a massive cyber breach or something like that. But in terms of getting it at even a reasonable price, it would have to produce some sort of bad news in a result. And I think it's going to be hard to do that while it's still growing at a decent pace and adding new clients, because when they're signing up these clients, they're only kind of declaring the fixed portion of the revenue that they're going to get. And then there's always this upside based on the number of exams that they're doing. And so I think they're just likely to keep out. I don't know. They're likely to keep beating at least their guidance.
It's not what we want to hear, Graham.
Yeah. Maybe it'll get to the case where you could argue that it's already at the point where people's expectations have been built up so much that it would only have to produce a moderately excellent result for it to disappoint people. And that would then send the stock down instead of producing some sort of overly magnificent result. So, maybe
a cyber breach.
Yeah, that can. I don't know. This might be a company where if there was some sort of cyber breach, that would be an interesting opportunity because, well, I don't know. That always opens up so many other different liability avenues. But
I really liked your scenario analysis you did, Graham, in the first piece that you wrote on this, where you sort of said, that really needs to take kind of 15% of the market. What's your kind of has that? Because I think you wrote that a couple of years ago. Where do you stand now? What's your sort of percentage of the market you think these guys need to get to kind of grow into their earnings?
Well, in terms of growing into their earnings, if you want to get them down from a PER of like 150 down to something more reasonable of 30, then it's going to have to at least kind of quadruple from here. So yeah, you're probably looking at above a 15% market share, which I wouldn't rule it out. Like, I think that's actually the base case. The problem is that if you're betting on the base case, you're not leaving any margin of safety for it not achieving that. So
in an industry at kind of peak disruption with AI too.
Yeah. And also there's no doubt that the competition are watching them and are going to be trying to copy it. Every other it's not an industry that is lacking competitors. There's dozens, there's at least 30 or 40 that are doing like similar things in the area. It's just that ProMedica seems to do it way better for some reason. But there aren't many tech companies that start off doing something way better that don't have the competition catch up a little bit. Maybe ProMedica can stay as the top player, but I can't imagine it suddenly capturing 100% of the market or something like that. It just takes too long to roll out, for one thing. And in that time that it takes to roll out, there are competitors who are working on building a similar product that can compete much better.
Well, on that note, I think our fingers are crossed for a hiccup, but I don't think we'll be holding our breaths. Gus, thanks for joining us today, mate.
Thank you. Thank you for hosting.
And Graham, thank you as well. I think it's pretty late over there.
6:30. Time for sushi.
Beautiful, beautiful. Well, you enjoy that. And for everyone else, thanks for listening.